Have you ever seen this happen? A company reports absolutely fantastic earnings, they beat all the expectations, and then you watch its stock just get completely hammered? Well, that's the bizarre story of what happened with NICE Ltd. And today, we're going to unravel that very paradox.
Okay, so let's dive right into the weirdness. On one side, you have the results, and wow, they were stellar. I mean, by any measure. They beat revenue expectations by a cool 13.5 million bucks. They beat their earnings per share, and they even raised their guidance for the rest of the year. It's like a textbook A+ report card.
But then, look at the other side. The market's reaction was just brutal, a drop of nearly 14% in a single day. So this is the real mystery, right? What in the world did investors see, or maybe what did they fear that sent them all running for the exits? What was hiding in plain sight? To really get to the bottom of this, let's first build the case for why the stock should have soared. We need to look at the overwhelmingly positive stuff NICE actually presented, because honestly, on the surface, everything looked incredible. First up, revenue. A really powerful $727 million for the quarter. Now, that's not just a big number, that's a growth of over 9% from the year before. And like we just saw, it completely smashed what the analysts were predicting. This is a company on the move. And you might be wondering, where is all that strength coming from? Well, here's your answer: the cloud. Cloud revenue now makes up almost 3/4 of their entire business. So this isn't some small side project, it is the core engine, and that engine grew by 12%. But here's the real showstopper: artificial intelligence. The recurring revenue from AI services, it exploded, an incredible 42% growth year over year. In today's market, you see a number like that, you expect fireworks. And this wasn't just some happy accident. The CEO, Scott Russell, he made it crystal clear on the call. He said AI is the heart of our strategy. So they are intentionally, aggressively doubling down on leading what he calls the AI-first transformation. And check this number out, because it's super important. What this means is not only are they winning new customers with this AI focus, but their existing customers are sticking around and spending more money. A net retention rate of 111% is really, really healthy. It basically means for every dollar they had last year from a customer, they now have $1.11. That's fantastic. So let's switch gears and put on our detective hats. With all this amazing news, what on earth could have spooked investors so badly? Well, if you start to dig into the earnings call transcript and what the analysts were saying, some little clues start to appear. It turns out, yeah, there were a few subtle but really important details that were kind of buried in the call, and they definitely gave Wall Street pause. They weren't obvious, but for those skeptical investors, they were more than enough to sound the alarm bells. So this right here, this breaks it all down. These are the 4 big concerns that came out of that call. Investors honed in on some unexpected weakness in a division called LiveVox, a small dip in profitability, the huge financial weight of a new acquisition, and finally, guidance that hinted things might be slowing down. Now, to really get one of those fears, we need to talk about gross margin. Just think of it as a measure of how profitable a company's core business is on the stuff it sells. NICE's margin dipped just a little bit, mainly because they're investing heavily in their cloud platform. But even a tiny dip like that can make investors pretty nervous about profits down the road. And here it is. The biggest uncertainty of all was this number: almost $1 billion. That's the price tag for their new acquisition, a company called Cognigy. Now, while it's a huge bet on the future of AI, it's also a massive expense and a major risk, at least in the short term. So you see what's happening. This all boils down to 2 completely different stories being told at the exact same time, one by the company's management and a very different one by the market's reaction. On the left, you've got management's story, right? It's a visionary, long-term plan about AI dominance, all fueled by smart investments and big global deals. But on the right, you have the market story. And that one's all about immediate fears, shrinking profit margins, the massive risk of a billion-dollar deal, and hints that things are slowing down. This brings us to the big question, the one that really matters. Which of these 2 stories is going to win out in the long run? Well, the answer is probably going to be found in a few key events coming up on the horizon that you can bet every single investor is watching. So keep an eye on these dates. In October, their Capital Markets Day will reveal their big financial goals.
Then, in the fourth quarter, that huge Cognigy acquisition will close, and we'll start to see how that whole integration process goes. And then, by the middle of next year, a massive deal with the UK government is set to start bringing in serious revenue. These are the moments of truth that will prove which story was the right one all along.
And that leaves us right here with the final question, the one at the very heart of this entire paradox. Is NICE's massive all-in bet on AI a brilliant visionary strategy that's going to define the future of customer experience? Or is it a super high-stakes, costly gamble that could jeopardize the very profitability that made it a market darling in the first place? Only time is going to tell.